This week's number, $4,000. That's how much some parents are paying sorority recruitment consultants to help their daughters get into the sorority of their dreams. What grows when you plant a pumpkin spice latte and water it with vodka? A sorority. True story, Claire. Claire, by the way, is co-hosting today because Ed is off in Mykonos getting shut down by every woman at some cheesy club that he's at. But
Yeah,
true
that's
story,
right.
Claire, before we bust into it, let's talk about me. I was the president of the Interfraternity Council at UCLA. I was the king of the jarheads, the douchiest douchebag in Doucheville. That's right.
Of course you were.
I was. True story. True story. Okay, welcome to Prof G Markets. Today, we're discussing Twitter's disastrous rebrand, Mattel's big IP play, and Spotify and Snap earnings. Here with the news is Prof G Markets producer Claire Miller. Claire, what is going on?
I'm hanging in there, Scott. I'm here on the mic for the first time in, I think, a year, covering for Ed while he's off in Mykonos, as he would pronounce it. I texted him last night to see if he's had any luck pulling any ladies. Haven't heard back yet, so I don't know if that's a good sign or not. But
Yeah, good money's on no. Good money's on no. But
well, we'll just
anyways.
have to stay tuned till he's back. I know our listeners are on the edge of their seats.
There you go. Talk about the markets.
All right. Let's start with our monthly review of market vitals. The S&P 500 gained about 5% in July, bringing it close to a new record high. The dollar fell around 1%. Bitcoin dropped 4%, while the yield on 10-year treasuries gained 4% on the news of the Fed's latest rate increase. Shifting to the headlines. Meta posted double-digit revenue growth for the first time since the end of 2021. The company also lowered its capital expenditures forecast for 2023, but noted expenses could grow next year due to investments in data centers and AI. The stock rose 8%. Google beat expectations for revenue and earnings per share. It also posted its second consecutive quarterly profit for its cloud unit and showed strength in its core search business. The stock rose 6% on that report. Meanwhile, Microsoft's stock fell 4% on news that revenue growth in its cloud business slowed quarter over quarter by 1 percentage point. Microsoft also gave weaker than expected guidance, signaling it will take time for revenue from its AI investments to materialize. Tottenham Hotspur owner Joe Lewis was charged with insider trading. Federal prosecutors are accusing the billionaire of sharing non-public information with friends, associates, personal pilots, and romantic partners. The Federal Reserve raised interest rates by another 25 basis points, bringing the federal funds rate to a 22-year high. It was the 11th rate hike in a bit more than a year. Still, it might not be the last. And finally, UPS and the Teamsters Union reached a tentative agreement for a new contract, narrowly avoiding a strike that was set to derail a significant piece of the economy as early as tomorrow. Notably, existing part-time workers will see their pay raised to a minimum of $21 an hour, up from $15.50. Scott, any thoughts?
Well, let's take these in reverse order. I love the fact that the Teamsters have been able to do what the federal government should be doing, and that is get people a living wage. I don't think it should be $21 an hour. I'd like to see federal minimum wage with some exceptions in rural areas where the cost of living is much lower at $25 an hour. If minimum wage had just kept pace with GDP growth or productivity, it'd be about $23 an hour, and I think it's $7.25 right now. I think it's core to the American experience. Specifically, we're a generous, innovative, freedom-loving people, but we're also about work, and I think we need to bring dignity back to work. So as I always like to do, I always like to contrast it with the leadership of the WGA and SAG and AFTRA, who, despite being famous and likable, have their heads up their asses. And that is, the UPS realized, or the Teamsters realized they had leverage, because the day they went on strike, UPS started hemorrhaging money, and it was really bad for UPS. Contrast that with the studios, specifically Netflix, that just announced because of the writer's strike, they have $5 billion in cash on hand now because of this multilateral pause on spending that the strike has created, which is very good for Netflix, and they're going to start doing share buybacks. So one group of people, the Teamsters, had real leverage. The WGA has absolutely no leverage, I would argue, negative leverage. And get this. Look at the negotiations here. Look at the demands. The demands of the writers include limits on the use of AI by the studios and a certain number of writers in every writer room. This is what the Teamsters asked for and got. An increase to $21 an hour. I think that's reasonable. And two, get this, they demanded and got air conditioning in the trucks. Okay, that seems reasonable. What is the WGA asking for? A pause, non-use of AI, and minimum number of writers. That would be the equivalent if the Teamsters had asked UPS for a pause on any development around autonomous driving, which they knew they wouldn't get. They didn't even ask for it. And two, if they demanded 2 drivers on every UPS truck. That is how, in my view, ridiculous the writers are being, much less not recognizing that they have no leverage. Anyways, I'll stop ranting. The Federal Reserve, it feels to me like they have created, I think Jay Powell should be Times Person of the Year. We have the Goldilocks economy right now. Other than the Kingdom of Saudi Arabia, our economy is the strongest in the world. Our GDP growth has been consistent, if not remarkable. Inflation, as we predicted, has come down as quickly as it went up. He got a ton of shit from people on the right who were second-guessing everything under a Democratic administration, hoping for hyperinflation such that they could get their guy or guys back in office. And let's be honest, on the Republican side, it is all guys. And then on the far left, we have Senator Warren, screaming and yelling that this irrational increase in interest rates was making it hard on working families who all of a sudden had to pay higher credit card bills. Yeah, you're right, Senator Warren. It's even harder on families. Hyperinflation. That's one way to really ruin an economy. And Chairman Powell was steadfast, kept raising rates, and we have historic low unemployment. Real estate prices seem resilient. I mean, and for the first time, over half of economists are now saying that we're going to have a soft landing and no recession. So Chairman Powell has put on a masterclass, in my view, and not only a broader understanding of the economy, but having the backbone and demonstrating the leadership to just screen out all the people second-guessing him from the right and the left. Tottenham Hotspur, I hate to hear anything bad about the Spurs. My youngest, his team is Chelsea. My oldest, his team is Spurs. I'm kind of Rangers and a little bit of Arsenal. But my oldest loves the Spurs. We go to a bunch of games. Kane and Son make for great strikers. It's got the most beautiful venue in London. So I don't know what else to say about this. Let the authorities figure it out. Microsoft, Microsoft, okay, their stock's maybe down 4%, but it's up since what is the greatest corporate venture investment in OpenAI. They have started announcing that they're going to bundle AI into their Microsoft Office franchise, which is the strongest corporate recurring revenue business in the world. I bet 95 or 97% of companies that do over $10 million a year in revenue have a recurring revenue relationship with Microsoft vis-a-vis Office. It's doing. Microsoft is one of those stocks you just probably want to have in your portfolio and ignore it for 20 or 30 years. Google, on fire. Cloud Unit showing strength. Its Cloud Unit went profitable for the first time, and it's never going to look back at unprofitability. Something like 70% of all generative AI unicorns are powered by the Google Cloud. Meta, big tech company of the year from a stock perspective. One of our stock picks in late 2022 was Meta. Overly Punished was trading at like $80. What is it now? $300 or $400. I mean, it's just, the peanut butter and chocolate of maintaining growth as you cut costs. That means champagne and cocaine for earnings. My top line revenues continue to grow while I cut costs. Oh my God, Claire, that is seriously crazy. So Meta is the stock of the year. I think it's increased more than any. I think it's up 3 or 4x in the last 12 months off of lows from the end of 2022. So they're doing really well. And also the market is giving them a greater multiple because they believe now that Mark Zuckerberg has waken up from this fever dream of the metaverse and is going to start reducing expenses around what will be kind of probably the greatest or the worst investment in corporate history, and that is this investment in the metaverse, where he's still burning, I think, $1.2 billion a month. But here's the thing: when you sit on this cash volcano called Facebook and Instagram, they can spend that kind of money and still be fine. Anyways, this is an exciting week for big tech. The bad news is that the smaller guys, including Snap, reported really challenged earnings, and it all leads to the same place. There's just too much concentration of power, and while these companies have incredible execution, they're benefiting from what are essentially monopolies in some of the biggest sectors in the world: social media and search and software. So this is more evidence that these are amazing companies and probably should be broken up. What are your thoughts, Claire?
Well, yeah, we'll get to Snap later in the show, but I wanted to ask you kind of about the health of the S&P right now. So we're closing out the month. It's inching kind of closer to a new record high. I think as at the time of recording, we're less than 5% away from a high water mark on the S&P 500, last set at January 3rd, 2022. So we've had a lot of earnings this week. Is it still just a big tech buoy, or, I'd asked you a couple weeks ago, is this a bull market that's being lifted by these big tech stocks, or do you think we're in a true bull market for, the little guys as well?
Yeah, the bull market is being kind of driven by a small number of bulls, and that is the vast majority of the gains in the S&P and the NASDAQ are represented by a small number of companies. When you have Facebook, a company valued at, it's probably almost $1 trillion now, up fourfold, that just represents a huge, the NASDAQ is an index, and that is Apple represents a large portion of the NASDAQ's metric because it's weighted by market cap. Those gains, or that champagne and cocaine party, the majority of the S&P 500 has not been invited to that party. And
Right.
Again, it's more evidence that more and more prosperity and shareholder gains are being crowded into a small number of companies. So everyone has sort of participated in this, but it's really a small number of companies that have been driving the gains.
And our GDP data for the U.S. came in this morning. GDP adjusted for inflation rose at 2.4% in the second quarter. That's higher than 2% for quarter one. So consumers are strong right now. They're spending on Barbie tickets and Taylor tickets. Where do you think we're headed on this random walk? Is it champagne and cocaine for the consumers as well?
So random walk is really the term to describe this or any economy, and that is there wasn't a single economist that was predicting that, okay, we're going to raise interest rates 400 or 500 bips. Mortgages are going to go from 3% to 7%, but the real estate market is going to remain strong. That no one was predicting that this inverted yield curve, which supposedly always means a recession, won't mean a recession this time. And we're going to maintain historically low unemployment. Meanwhile, inflation is going to decelerate as fast as it's accelerated. No one saw what's happened in this economy happening. And that's one of the wonderful things about the economy is it really is a random walk. Oh, and by the way, the first half of 2023 was the best performance of the NASDAQ in 40 years.
Right.
So, they say markets climb a wall of worry. My God, they have scaled this wall of worry like no tomorrow. No one saw this coming. And it's just a lesson. I think the takeaways are, one, always be diversified. Two, the conventional wisdom is, more conventional than wisdom. That get any group of economists together, anything they coalesce around, the only thing you know about it is it's probably wrong or mostly wrong. And the key is just to keep investing, spend below your means, save money, invest across a diversified set of assets, because the bottom line is you just don't know. If all of us had invested based on what the market was telling you to do or economists were telling you to do, you would have sold most of your stocks, because when interest rates go up, people sell stocks and go into fixed income. Okay, so sell your stocks. That would have been a huge mistake. Maybe I shouldn't. Maybe, I'm going to wait and buy a house because costs will come way down because of increase in interest rates, and it logically means people are going to have less purchasing power. No, what happened was, as mortgage rates skyrocketed, people became trapped. People can't move because they have a 3% mortgage, and if they move, they'd have to go get a 6 or a 7%, which has resulted in an absolute dearth of supply, which has kept home prices high. No one saw that coming. So this is a random walk. And how do you protect yourself against the randomness of these walks? Diversification and living below your means. But this has been an historically strange economy, and that strangeness has been good for America. Really, other than the Kingdom of Saudi Arabia, which grew at 8% last year, I would challenge anybody to look at our economy on a multidimensional basis, employment, growth, the markets, whatever you want to look at, and challenge anyone to look at any OECD nation that is doing better than the United States.
All right, let's move on to our first story. Elon Musk changed the name of Twitter to X. That's it, the letter X. He got rid of the iconic bird logo, replacing it with a black and white X, and he's trying to do away with all words and verbs associated with the brand as we know it, such as tweet. According to analysts, this rebrand wiped out somewhere between $4 billion and $20 billion in value. Scott, there are all kinds of obvious problems with this new name, from trademark violations to its association with porn. Where do you want to start?
So believe it or not, I'm considered a professor of brand strategy. I started a brand strategy firm.
Oh, I've heard, yeah.
Yeah, so I supposedly know a little bit about this.
Mm-hmm.
This is like so stupid. It's not even crazy. It's just stupid. I've never either Elon Musk is going to rewrite the basic principles of brand equity, or we're going to look back on this as one of the most obviously, visibly stupid decisions in corporate history. You know, probably 95, maybe 98% of all purchases are across brands you've heard of. You don't go out and buy a car, order a beer, or buy a shoe of a brand that you haven't heard. It's unlikely if you get an email from somebody and you know them, or you've heard of them. You don't even have to know them, but you've heard of them. You're exponentially more likely to respond. So awareness is an incredible asset, and it's also really expensive to build.
Right.
And Elon Musk, to his credit, has been a master at creating awareness, mostly through the use of Twitter and these reckless, sometimes brilliant moves. He's in the news every 24, 48 hours and recognizes that if I maintain awareness across my brands, I won't have to spend money on marketing, and my margins will be at the highest in the industry, specifically Tesla, which saves $1 billion a year spending on traditional advertising, which is what GM has to do. So he's been a master brand builder, and then this is a master class in what not to do. Twitter has global awareness. Almost everybody knows what Twitter is. In addition, the bird logo is arguably one of the strongest visual metaphors in the world. It has been at the bottom of every TV, news show. People say, follow me at Joe Rogan or at Morning Joe. Everyone has had that. Twitter logo has had trillions of impressions.
Right.
And it's a nice logo, and it connotes a new economy, a microblogging app, news, information, innovation, all of these wonderful associations. And to take that awareness and those associations and that asset in the form of a visual metaphor and just burn it in the street for a brand that has been banned already in Indonesia because they're worried it violates porn rules, for a brand that other companies are already saying we have rights to that trademark, for a brand that sounds like the strip club a bunch of people go during a crypto convention. I mean, this just makes no sense at all. I just don't. Claire, if I said to you, here's $10 billion in 10 years, and I need you to build a brand that has global recognition and positive associations, you probably wouldn't be able to do it. So
Right.
This is him going into the street and lighting billions, if not tens of billions, of brand equity on fire. This just makes absolutely no sense. I think the larger learning here is that success makes you stupid. I think you start believing your own press. You start making decisions out of gut and instinct because everyone around you is telling you that your gut and your instinct are infallible. Every person I met to a person is fallible. And this guy is like the king of fallibility right now in terms of some of the decisions and some of his behavior. I wonder if there's just too few people with too much money. When you can spend $45 billion and basically start spreading conspiracy theory and make, there's a wisdom of crowds. If he had a board, anything resembling a credible board, that had anything resembling any domain expertise around basic marketing, someone would have stopped him from this and said, boss, you really need to rethink this. But because he can buy the company for cash, or near all cash, $13 billion in debt, I think $33 billion in equity, and have no board, no oversight, no one on his shoulder to tell him what to do, or everyone around him is just telling him he's awesome, or he doesn't listen to anybody else. This is just such an interesting lesson in how power corrupts your thinking, and hubris really does kind of contaminate your logic and your reasoning. So Elon Musk will go down as one of the greatest brand builders in history, who has made arguably one of the worst brand decisions in history.
Yeah. Yeah, I mean, just it's interesting that you latch on to the logo. I feel like it's one of the most undervalued assets that Twitter has going for it. And now this X logo, to me, it literally looks like a wrapper for a condom that's going to break. Like, it looks just dangerous and gross. And, like, I see it, and I don't even want to click on it. Like, Carmen, my girlfriend, keeps sending me X posts, I guess, and I don't want to even open them because
X's.
it just, X's like that, and he's trashed like the words, the language that we use to talk about how we navigate this space. Like, we can't even call it a tweet anymore, or a thread. Threads has basically taken that word from them. And, I think it's also interesting that Threads put out their logo and it was black and white. And then a couple weeks later, Elon puts out a black and white logo. Who knows where he got it from? I think I've seen a few different origin stories. They all seem very random and rushed. But at least Threads logo looks like whimsical, fits the brand, and it kind of got people talking. This just looks awful to me. But let's pivot a little bit. We had the HBO Max rebrand earlier this year to Max, and we kind of said that would be the worst branding move of the year. But it looks like we were wrong about that. So can we let's go through some of the best and worst rebrands, and can you just give us a crash course on who did what well?
Well, there's been a lot. First off, I just want to acknowledge a condom that's about to break. That's good. That's good. Thank you. Oftentimes changes are just for simplification or for M&A reasons. So Apple Computer has just gone to Apple. That makes sense, right? PricewaterhouseCoopers, PwC. Right. Dunkin' Donuts. All right, we want to be known for more than donuts. Dunkin'. Kentucky Fried Chicken. There's some issues there. Let's call it KFC. Tokyo Tsushuin Kogyo became Sony. All right, that makes sense. Some of the brand changes that didn't work. Datsun becomes Nissan. Datsun was a great brand in the U.S., but because of ego, the folks in Japan wanted a global brand, and they convinced themselves they should change the name to the brand that was everywhere else but the U.S., and they changed it to Nissan, which created confusion, and it literally took Nissan probably a decade to recover from that. Facebook to Meta, I mean, that's sort of a minor fail, but they kept the consumer equity. They didn't change the name of Instagram. Right. Sometimes people try to do it to escape something. So I think it was Philip Morris changed to Altria, but people still realized they were still killing our sisters and our brothers. There's Google to Alphabet and Facebook to Meta, but that was primarily a means of creating more CEO roles. I saw that as a retention vehicle. You could have Sundar be the CEO of Alphabet, but also have CEOs of Google, YouTube, et cetera. And that, even if it was the wrong idea, it wasn't going to have that much of an impact because the corporate brand is for investors and employees, and so there's not as much risk there. It's when you start monkeying with consumer equity that it really makes no sense. This will go down as one of the kind of the biggest failures of a company of this size. It just makes absolutely no sense.
So you've gone through rebrands at your own businesses, most recently Section. You've got Profit, L2, Red Envelope, which I learned yesterday was originally called 911 Gifts. walk us through the best and worst of Scott Galloway's rebrands.
Yeah, so starting a brand strategy firm or being a professor of brand strategy doesn't exclude you from really stupid brand decisions, and I made a bunch of them. So Section 4, our online learning platform, where we're trying to offer 60 to 80% of an elite MBA course at 10% of the cost. Simply put, Section wasn't available, and now it is. We went out and bought it, so we changed the name from Section 4 to Section. So that was just pure simplification. I think that makes a lot of sense. I don't think there's a lot of confusion there. Going way back, Profit Brand Strategy. It was initially called Profit Brand Strategy, and then we started doing a lot of internet strategy. We got hired by Levi's and Williams-Sonoma to build their first e-commerce website. So we just said, let's just call it Profit. The real brand clusterfuck that I was responsible for was I started in 1995. I went and saw John Doerr, the founder and senior partner at Kleiner Perkins, speak at Berkeley. And he said that the internet is all about saving time and it's all men. And so I thought, okay, what do men need to save time around? And I thought, buying gifts. So I'm going to create a database-driven website where you type in the name, the person, the type of person, their interests, your price range, and it uses a database to spit back gift ideas, right? And I called it 911 Gifts, and the tagline was the right gift right away. And the idea was it would save you time, and you could be a great gift giver in a short amount of time. And the site and the company actually, the sales escalated really quickly. And then it was the late 90s, and I went to these stupid engagement parties where we all pretend that we're interested in watching people open gifts because they're getting married. And someone opened a gift, and it said 911 Gifts. And I'm like, oh, my God, what a nice moment for me. Someone got them a gift from 911 Gifts. And it was this beautiful Nambe forged metal bowl. Nambe is this great brand that has this kind of Native American feel to it, and it's really cool, sort of, I don't know, I guess you call it kitchenware. And the bride or the bride-to-be said, oh, this is lovely, and said, where did you get it? And she turned it over, and it said 911 Gifts, and she looked up and jokingly said, you thought about me last minute? Question mark. And occasionally, Claire, in life, you have a blue flame moment. Where
that was it.
You register people's emotions, and you're like, oh, she likes him, or, oh, this person is insecure about this, or, oh, this person is lying, or, oh, we should absolutely do this. You have a blue flame moment where you just feel like you know the truth. And at that moment, I had a blue flame moment, and that moment was, I'm fucked. I had started a gift company where the brand has negative recipient associations. And so we changed the name to Red Envelope. And a little bit more of the backstory here, it was going to be called Box and Bow, either Box and Bow, Red Envelope, or, God, I forget what the other one was. And the CEO of the company, a woman named Hillary Billings, who was our first CEO, that wasn't me, chief merchant, actually, that's not true. I think a guy named Pete Baltack was our first CEO. Anyways, Hillary chose Box and Bow. And the chief merchant, a woman named Christine Deng, came in and said, do you know the story behind Red Envelope? And she was from Vietnam. And she said, essentially, a red envelope and gold coins are a sign of prosperity, and you get them from your parents and grandparents during holidays in Vietnam. And she showed me these pictures of her as a kid opening a red envelope. And I'm like, that's it. That's it. The origin story of brands are really powerful. And I thought sort of the cleanliness and the kind of romantic precision, sort of mysterious East feel, it just all fit. And one of the few good things I did at Red Envelope was I demanded, I said, no, Red Envelope's going to be the brand. This works really well. And so we went through a brand change. We were still pretty early in the company's history. It was easy to raise capital. We had just raised, I think, $20 million from Sequoia Capital, so we could do the name change. And Red Envelope is actually one of the brands I'm most proud of. Luxury Lab was the analytics company I started while teaching at NYU. It was originally going to be a center at NYU. They didn't want it, so I spun it out to a private company. Luxury Lab was the right brand. We were doing analytics and digital benchmarking for luxury brands who were underserved at the time and growing really fast. And then P&G and Unilever called it in the same week and said, do you ever work with CPG companies? And I hung up the phone and I said, we're changing the name to L2. So that made sense because our customer changed. You want brands that have a lot of latitude, that are sort of empty vessels. So initially it was Luxury Lab, then L2 Think Tank, and then just L2. So by all means, I get it wrong all the time. This stuff is hard, but name changes are generally a bad idea, and you really want to be thoughtful at the beginning. You want to opt for something people can spell. Ideally has some positive associations or associations congruent with the category, and give you a lot of latitude because you don't know what products or what industries you're going to go after, and then don't change it.
Is there a world where you would rebrand us, Prof G Media?
Probably. Yeah. I mean, at some point, that feels very tied up into a guy with anger and ED issues. So look, I don't know. I don't know. I'm not sure I ever see us as a large consumer company. And I think that vessel around Prof and G, it's associated with me, but I think we could take it other places. But yeah, at some point it might become PG Media, but that means parental guidance suggested. I don't know. I don't know. Sounds like I fucked up again.
No,
I'm changing it to X. I'm changing it to X.
There you go. All right, let's move on to our next story. Barbie and Oppenheimer, together known as Barbenheimer, hauled in $244 million at the box office in their first 3 days. That was the best opening weekend for the domestic box office since 2019, when Avengers Endgame premiered. But perhaps the biggest winner here will be the toy company behind Barbie, Mattel. The Barbie movie hype cycle sent the stock up 18% year to date. And for the past month, while we were distracted by Nvidia, Microsoft, and Meta, Mattel actually outperformed all of them. Now, the toy maker doesn't expect to see significant sales growth for Barbie toys until the second half of the year. In fact, Barbie sales actually dropped 7% in the second quarter, which ended weeks before the movie's release. But Mattel's CEO said that this quarter, and crucially, the Barbie movie, established the company's media strategy going forward. He said, quote, "This moment will be remembered as a key milestone in our company's history." So, Scott, let's talk about that strategy of basically repackaging and reselling old IP. Mattel seems to think it'll work. How far do you think IP can actually take a company like this?
Look, this was a genius move. Barbie is sort of an anachronism, and that is a lot of the associations of Barbie, and a doll that says, kind of communicates to the world, be anorexic and then go get a boob job. That's not exactly like a modern statement on feminism. But to their credit, they managed to pull together. I mean, this movie, it could have easily been so bad and so panned. And the execution around it, I haven't seen it, but everyone I know that's seen it, they've managed to thread this needle where it just seems like everybody likes it except Ben Shapiro and Matt Gaetz, which is a plus, right?
Yeah, exactly. That's a win.
And it's just raised a ton of awareness, and you've highlighted that the stock is up. It's going to cut a lot of revenue for them. It might be a franchise. My guess is there's going to be a Barbie 2, 3, 4, 5, and 6. Oh, God, that depresses me just thinking about it. But it is so hard to have a profitable movie. It is so hard to have a profitable toy. So what Disney's been great at, and now it looks like Mattel, is taking IP and leveraging it across different sectors and different mediums, specifically taking Barbie to the movies. And then what Disney has been great at doing is creating movies and taking that to the toy store. So this is the execution here sounds like it was just flawless. It sounds like this movie took a topic and an item that could have easily been panned and just thread the needle. My co-host, Kara Swisher at Pivot, won't stop talking about Barbie. Literally, she's just...
Yeah. I won't either.
You loved it.
Yeah, I loved it. Yeah, and I mean, I did the double feature on Saturday. I did the Barbenheimer double feature. It was just kind of a joyous experience. And,
that's a lot. That's 5 hours of movies.
Yeah, no kidding.
That's a lot.
But it was worth it, and it just felt like it had this. I've experienced a sense of camaraderie that I don't think I've felt since and maybe the past decade. I think the last time I felt like that was going to the final Harry Potter movie, and people were dressed up there. and now they're dressing up to go to Barbie and wearing pink, or they're like, dressing like Cillian Murphy. Sorry. Basically, I think it was a huge win, and I think the reason that people went to the movie and it wasn't panned is basically Greta Gerwig. I mean, she's one of the most, I think, visionary directors we have right now. She always has something to say and is a great storyteller, I'd argue. And then that's this brand marriage between her and Barbie. You were talking about the value of a brand with Twitter. Barbie has 99% brand awareness worldwide. She's the perfect leading lady because, like, almost everyone in the world immediately knows who she is. So I think, that came together perfectly with a great director in Greta Gerwig, a great cast. And I think it's going to be hard to replicate. I mean, are there many other toys that can, carry 99% brand recognition in the world? I doubt it. And I'm sure studios will still try. Mattel has 45 projects in development, 14 films currently in production. But who knows?
Yeah, so look, something you said is really powerful about this, and I felt the same way. People often say it's a shame that box office people aren't going to movies anymore because in person, because there's a certain collective, there's a certain feeling of comity, of sharing that experience with a group of strangers. And one of the things that was most inspiring, and I didn't see the movie, I took my son, we visited LA, and I took my two sons to the Century City Mall, and everyone was roaming around in pink. Both women and men. And that was really nice to see something that brings people together. And my son said, it's amazing, isn't it? I didn't know there were so many Messi fans in LA. He thought they were all wearing Inter Miami kits and jerseys. I'm like, no, this is because of the Barbie movie. So I agree with you. I think it's really nice. We need more reasons to come together. It's also, Mattel really needed it. The Barbie brand earned $1.5 billion, a decline from $1.7 billion in 2021. So they needed something, and they have found this, and they want to create something called the Mattel Cinematic Universe. And my guess is, similar to Marvel or DC, they've now convinced a lot of studios and capital that they have a bunch of assets they can turn into movies. I mean, they have some iconic franchises: Hot Wheels, Fisher-Price, American Girl, Thomas and Friends. So this is, good for Mattel, good for the stars of Barbie, good for the planet.
Yeah. And good for me, I bought the stock in April.
You did. That's right.
It's like the only stock pick I've ever made. I keep everything in ETFs, like we talk about on this show. But when the teaser trailer came out, I saw just crazy hype for this movie that was 4 months out. And I looked at the stock. It was trading well below its COVID levels. But obviously, it had a big run up with parents buying more toys for kids stuck at home. It was way below those levels. It was kind of trading below its normal levels, I'd say, pulling out even further. And, I thought it might be a buy at that point. I went to my brokerage app, Charles Schwab, and they had it set as a buy rating. I turned to Mia next to me at the office. I was like, I'm gonna buy it. How much should I get? She's like, I don't know, $20. I was like, no, I need some skin in the game. I need to like make a bet on this, and I did. It's kind of paying off for me, so I'm excited.
Good for you. That's great.
Last question, Scott. Are you going to see Barbie, and what are you going to wear?
I am going to see Barbie. It's going to involve edibles, and I may just throw on a wig to pretend I'm Ken.
There you go. Let's move on to our next story. Spotify reported record audience growth for the second quarter, but its stock fell 14% on news that its podcast division was still suffering from weakness in the digital ad market. Results were even worse at Snap, which posted its second consecutive decline in quarterly sales and also saw its stock decline 14%. That's in contrast with Google and Meta, which posted advertising revenues that topped analyst estimates. Scott, why are these results so mixed?
Well, it's just really good to be an unregulated monopoly. And that is, look at the company that dominates search. Look at the company that dominates social. Look at the company that dominates software. And all of those companies had huge quarters. And then look at the company that's super innovative, great product, great management team, great founder, but they're subscale, and their oxygen is being sucked out of the room. So Snap is one of those companies. Snap is sort of, in my opinion, exhibit one for why we need to break big tech up. It's a great company, and it just can't compete with these monopolies, because what you have is people who are in charge of digital spend just say, all right, we're just going to give it to Google and to Meta because they control everything and they have the money to invest in better ad tech. And the smaller guys just can't compete. So Snap fell 14% after reporting Q2 earnings as investors reacted to weaker than expected guidance. The revenues declined 4%. Their net losses narrowed to $377 million. It's still very dependent upon digital marketing spend, which has declined over the past year. The U.S. advertising market is expected to grow 6% in 2023, lower than the 9% growth seen in 2022, although digital marketing is just being, when you're growing when you're growing your revenues top line by 12%, such as many of the big tech in media, and the market's growing 6%, that means that someone is declining in revenues, and Snap is one of those folks. There are some real bright spots here. Daily active users at Snap reached 400 million, up 14% from a year earlier, and over 150 million users sent more than 10 billion messages to Snap's AI bot. So in sum, and this is kind of the prediction here, something's going to happen, I think, with Snap over the next 12 or 24 months. Now, the reason why this prediction is less certain is that it's one of these dual-class shareholder companies, and one person, Evan Spiegel, controls that decision. It would be the right decision. This is a great product, a great company with a subscale platform. It should absolutely be tied up with a bigger platform. But he gets to make the decision. And unfortunately, founders are often already billionaires of these companies. So if it's a question between being worth, $2 billion and $4 billion, he'll probably opt for the $2 billion and maintaining control. Control is an addictive substance. But this feels to me like a company that should be part of a bigger company.
So who comes in and buys it, do you think?
Well, I think the logical one would be Disney, whose market cap is around $160 billion, and Snap's market cap is 17. And you can imagine that Disney says, all right, our traditional channels of distribution, movie theaters and broadcast cable, are in structural decline. What if we could directly communicate with 400 million younger users who advertisers love and start pushing through snippets and IP and movies and series to Snap? I think that could be really intoxicating, and also market all of our properties across those 400 million users. The brands feel good to me. After Bob gets done cutting costs, he's going to have to come up with a growth story. And at $17 billion, this company, keep in mind, the stock's at $10. It was at 85 at some point in 2022. That was obviously wildly overvalued. But it's at $17 billion, so it would be about a 10 or 15% dilution to Disney. Feels very brand on. They get 400 million younger users that are very much congruent with their products, and they would get a new channel of distribution for their IP and their content. The other outside shot would be Apple. The brands line up perfectly. I think Evan would be very successful at Apple. They could obviously blow this thing up by featuring it on the front screen of every iOS product. The thing is, Apple is not acquisitive. They think they're so correctly precious about their culture. They don't like to make large acquisitions. But the thing about it is, when you're talking about a company with a $3 trillion market cap, they could pay a 50% premium for the company, and it would be a 1% dilution. They would have to issue less than 1% of their shares to pay for this acquisition, even at a 50% premium. And if the thing didn't work, if the thing was a total disaster and a write-off after 2, 3, 5 years, I mean, the real cost would be the diversion of focus, but it would mean nothing. I mean, they could acquire Snap and pay for it with just change they find in their couch. But so it makes sense on a lot of levels, except they're just not that acquisitive. So I would think it might be Disney, or there might be an unusual deal. Iger said he wants to get rid of FX, and I think it was ABC. Maybe he spins it to Snap, and Snap becomes kind of a interesting media play for young people and starts running the content of those companies through their Snap platform. But my prediction in sum, Claire, is that something happens with and around Snap over the next 12 months. It's just subscale, and something needs to be done here.
Thanks, Scott. Let's take a look at the week ahead. We'll see job openings from June and the unemployment rate for July. We'll also see earnings from Apple, Amazon, Airbnb, Block, Warner Brothers Discovery, Uber, and many more. Scott, you made your prediction, but do you want to give it to us again?
Nope. I think something happens with Snap.
Yeah.
Thank you for watching this version of Prof G Markets. Check out our pod feed for office hours on Wednesday, and we'll be back with a fresh take on markets every Monday.